Good morning, everyone. Welcome to Daniel Krug and Associates Wealth Management Review. My name is Rocky Istvan. I am the Chief Compliance Officer and an Associate Wealth Manager here at Daniel Krug and Associates. Today, the name of our presentation is Picking Up the Pace. And Dan will be joining me in a little bit here to do some of the presentation, but I'm going to be kicking it off. First, just a reminder that this presentation is for informational and illustrative purposes only. If you've got questions specific to your situation, please call the office and we will set up a meeting and get that answer to you. We'd like to thank City National Rockdale for their contribution. A lot of the data we're using has been provided by them. Agenda today is I'm going to touch on wealth management. We're going to touch on major developments that happened over the week, an update on COVID, reopening and unemployment, the markets and investing, and then we will have Q&A at the end. So this is kind of our view of what wealth management means to us. There's 5 major categories that a true wealth manager works on. Obviously, a big part of it is this top section where most advisors out there do some form of investment consulting. Some obviously do it better than others, but that's a big part of what we do at Daniel Krug and Associates is help you with an investment strategy tailored to meet your needs. But where we differentiate ourselves from others is in the areas of advanced planning, such as wealth enhancement, wealth transfer strategies, wealth protection strategies, and charitable giving strategies. So a big part of what we do is the additional advanced planning that we offer to our clients. And today we're going to be focusing in on the wealth enhancement strategies as I bring Dan in to go on and talk about some of those strategies. So major developments this week. States have expanded reopenings with no major issues so far. That's a pretty big deal, and we'll expand on that a little bit. We believe the worst of the job losses may be behind us. Originally, the thought was that sometime around July, the unemployment would be bottoming out, but it seems to be happening a little sooner than that, which is good news for the economy. And then consumer sentiment. How do people feel about their health and the economy, and how that is key to the recovery, and that's actually improving. And then last, what's going on in the markets that's being supported by this continued monetary stimulus, and there's even talk of more coming. So we're going to touch on all that. Let me start by giving you an update of where we are with the COVID-19. And what this first chart is showing us, then even more than a month after states started reopening, there's no evidence of widespread increases. So we're closely monitoring the states. There has been some modest increases in hospitalizations and spread, but it's well within the expected range with reopening. So as you can see, most of the states here are doing very well, continuing to show a downward trend. Only Arizona, Texas, and Virginia had a slight uptick, but still, again, everything is staying well within the bounds of reopening. Fatalities are generally on a downward trajectory, so that's continuing to look good. And hospitalizations are also on a decline, and you can see state by state. Obviously, the Virginia, Wisconsin, and Washington, again, they're a little bit behind other states like Ohio, New Jersey, New York, and Pennsylvania in testing and things like that, and the actual spread of the virus. So you would expect to see a little bit more there. But the good news is that overall, as a country, we're seeing major improvement and continued downward movement in fatalities of COVID virus. This chart's a little busy and a little hard to explain, but I will try to tell you what's going on here. Again, this is bars represent every state in the country, and the graph on the side where it says 1 with the green line going across, what this is talking about is infection rates. And some increases in the rate of infection has been seen across some states since reopening. But again, it's staying within that acceptable range. And the one line across the bar, across the graph, means that how many people are getting infected as a result of somebody that already has the virus. And 1-to-1 relationship is what this one represents. So they're saying that generally only one other person is getting infected from somebody already infected, which is way lower than the numbers we were seeing relative to the infection rate from an existing person moving forward. So this is a very good sign that other people getting infected from those that have tested positive is declined and is staying very low with a 1-to-1 relationship. I hope I did a good job of explaining that. That one's a little tough. On this page, we see that the testing during reopening, it's generally on pace as about a week ago. We do want increased testing, obviously, as we are opening, and they are working on that. But the positive test rate continues to decline and stay well below the target, which is what you can see on the right graph. So as long as we're under that dotted line, we're well within the targets for reopening. And that line continues to go down. And the last point here is that Wuhan, where the virus started in Wuhan, China, has tested, according to China, all 10 million people. So their infection rate is not increasing, and they have tested virtually everybody. And we're wanting New York, because of the density of the population there, to do the same thing. Again, the same thing, this is talking about all over Europe, the different countries that were having high infection rates, that also European countries are showing acceptable rates of infection, and they are actually ahead of us in reopening. So now what I want to do is kind of switch our focus to what's going on with the reopening and unemployment in the United States. And Dan is going to come on to talk about that. Dan is the CEO and Senior Wealth Advisor at Daniel Krug and Associates. So Dan, if you want to join us, I'm going to hand it over to you.
Well, good morning, everyone. Thank you, Rocky. I appreciate the information on the update on COVID. That was very informative. So we're going to go on, and based on this virus that we've had, certainly there's been closings and everything, but now we're in a more of a reopening stage. So we're going to be looking at reopening and unemployment. So we'll start with the unemployment. The reality is unemployment may be a little bit worse than people are seeing from a number standpoint. And what do I mean by that? Well, this chart breaks it down into 3 different compartments and then the total loss of employment. And what we're seeing is, in addition to the 23 million officially unemployed that have effectively lost their jobs temporarily or permanently, we also have an additional 6 million that have left the labor force. On top of that, you've got another 6 million expanded eligibility workers that are unemployed as well. So the total is closer to 36 million. That's kind of the bad news. But there is actually good news, and I'll get to that as well. But when you think about the number of people that are unemployed, and you think about the gross domestic product, the GDP, you know, our GDP is an economy driven by consumption. In other words, consumers make up 77% of our GDP. Then you have government, which is the next highest at 17, and then investments at 14. And then to kind of take away a little bit from the GDP, we have our net exports. But at the end of the day, you can see that the gross domestic product is largely consumer driven. So when you're talking about the number of people that are unemployed, it is really vital for our country to get people back to work. And that actually is taking place. Now, thinking about the people that have been laid off, there's actually fewer layoffs going on and fewer checks being received for unemployment. Why is that? Well, we've actually got about 6 million people that have gone back to work. So the claims have gone down, and that's a very big relief right there. If you think about the steady return to work, and this chart really talks about hourly workers, at the height of the unemployment, which was close to April 11th, you could see that hourly workers were only working about 60% of the time, and that's really not enough to sustain yourself. But you can see over time, going to the latest data, which is on 5/27, you can see now it's down to 34%. So people are getting back to work. That's a great thing. A lot of it is due to businesses opening back up, especially small businesses that are bringing back their employees to meet the criteria for the Paychex loan forgiveness criteria. So we expect this to continue to move forward as the weeks go on. So we'll be monitoring that for you. Talking about an interesting development here, the impact of government relief programs has actually spiked the personal income for April. So when you're looking at this graph, we've got on the right-hand side, you've got March's personal income was down about 2%, and April spiked up to about 11%. And that is largely due to the increase in unemployment, the enhanced unemployment benefits, and the one-time $1,200 government check that was given out. So it is actually putting people in actually better position than they were certainly a month ago. Now, when you think about individuals and their savings, it appears that based on the data that's coming in, people are saving for a rainy day. And this chart, when you look at it, the way the chart is set up, the left axis, you've got percentages, and that is the percent of income. And then on the bottom axis, you've got the last 3 months. And the way this chart is broken down, you've got taxes on the top, you've got savings in the middle of the bar, and then you've got spending on the bottom. And in February, spending represented about 81% of the income coming in. Savings was 7%. If you fast forward to April, the spending was greatly reduced. Why is that? Well, because people aren't getting out and spending money. What is the result of that? Well, the result of that is that there's now about a 30% savings rate going on from the income that's coming in. So this is actually going to give rise to greater spending when people are able to get out and the economy opens up more and more. So thinking about consumers and their debt and savings, if you go back to 2008 and the 2008 crisis, the reality is most consumers, the average consumer, the average household, had a debt up to 98% of the GDP. When you're looking at it today, crisis, we were looking at 74%. So that's dramatically lower, which actually put people in a better position to be able to weather the storm. That and the fact that the government is enhancing the amount that a lot of people are getting is going to put us in a better position moving forward. Now, when you think about it, and I'm kind of going to look at this from an isolated standpoint, restaurants only. Restaurants are gradually opening. If you go back on this chart and you look on 3/22/20, the total spending at local restaurants year over year was down 76%. Fast forward again to 524, and it's now risen to 54%. Certainly not high enough for these restaurants to be profitable or even break even. So the more it opens up, and it looks like even in Michigan, they're going to expand from 25% capacity to 50% capacity in the coming week here. So hopefully that will help restaurants bring more people in and get the spending where it needs to be so they can, again, be profitable. So that brings us to markets and investing. From a markets and investing standpoint, we're always looking at the financial speedometers by City National Rockdale. Again, one of our high net worth investment managers that we have. They're institutional managers, and they just do a fantastic job. Their research is top notch, which is one of the reasons why we use their speedometers. But in this case, these three speedometers are really representative of the credit market conditions. So again, going back to how to read these speedometers, you generally have red, that's negative, yellow, that's neutral, and green is positive. So looking at this from a credit standpoint, credit is improving. How do we know this? Well, because you've also got hands on these speed dials. The dotted hand is what happened in the previous week, where we were, and the solid hand is where we are today. And you can see from a credit standpoint, we're actually improving there. That's a great thing. If I go all the way over to the right side and look at the liquidity is improving also, and that is largely due to the monetary policy that the Federal Reserve has put into effect. So they've said it, they're not going to let the credit markets go down. So we're pretty confident that this is on pretty solid footing. So no real worries there on the credit side. But there are some concerns when it comes to bonds. If you've been in any kind of meeting with me talking about investments, you've heard me talk about the fact that in 2012, we actually rolled from a secular bull market in bonds to a secular bear market in bonds. And that's kind of representative on this graph. If you look again on the left axis, you've got the percentage of yield. On the bottom axis, you've got the years going from 2005 all the way to 2019. The black bar represents the investment grade bond yields, and the blue bar represents the high dividend stocks yields. And you can clearly see after 2011 that the yield for bonds has dropped dramatically. So whereby in the past, you might have been able to get away with a 5-6% yield out of a bond portfolio. Today, that's simply not the case. So, and if you know anything about the secular markets with bonds, the last two lasted 32 and 35 years. I'm not saying this one will last this long, but we do know the bond secular market lasts longer than a equity secular market. Now, what can you do about those low yields? Well, if you're a static investor, you're kind of stuck at low income coming out of these yields, and quite frankly, below inflation rate. So you're actually going backwards in buying power. If you're more of a tactical investor, you have the ability to shift some of the portfolio from investment grade bonds over to high dividend stocks. And this kind of represents the prevailing percentages at this point, where you can see that the high dividend stocks are outperforming the investment grade yields by about 2%. When you look at the dividends, some people ask, well, yeah, but are my dividends safe? Well, if you look at this chart, this is representative of high dividend stocks and the normal US large cap stocks. High dividend stocks generally are going to be 4% or higher. The average stock that has a dividend is closer to 2%. And in this chart, you can see as the market decreased, the dividend yield rose on both sides. But you could see that on the dividend for the high yield stocks, it went up much higher and has stayed higher than the large caps. So that brings us to strategies when it comes to these type portfolios. I showed you this chart last week. I really only want to focus on two things, and that is if you're a traditional bond investor, in an example of this would be income portfolio 1, you really can only anticipate a 2.2% yield out of that moving forward for the next 10 years. If in fact you are more tactical, not traditional in the investing, but tactical in the investing, like our firm is, you will find that if you shifted a percentage of the portfolio to higher dividend stocks, in this case, a 30-70 portfolio, you can see that the projected 10-year return goes up to 3.6. So that's a 1.4% difference. And that's a big deal when it comes to income year over year. So that is one of the reasons we are a tactical firm. If we move on, looking at the overall equity markets, the financial speedometers for the market kind of looks like this. It's not so rosy as the equity market at this point. The fear indicator, which is a contrary indicator, is getting more and more red. Now, does that mean there's more fear? No, it doesn't. It means that people are actually less fearful when it comes to the market. Now, I'm going to shift all the way over to the other side, the right side. And if you look at valuations, you can see valuations are actually going down as well, as far as the red meter. Now, does that mean valuations are going down? No, we'll see that the PE ratio on this next slide is actually getting worse. So in this, what you'll find is that the price earnings ratio for the S&P 500 is actually raising at this point. It's now up to 21.91. Last week was in the 20s. So as the stock market goes up, but the earnings don't show up, you're going to find this ratio is getting more and more out of whack. So we can see that the S&P 500 is overvalued. And again, when you look at where the institutional money managers would like to see the price earnings ratio, they'd like to see it closer to that 14-15 ratio instead of where we are right now up at 21. Because again, fundamentally, it's not really sustainable. Which kind of brings us back to where we are now. The S&P 500 just keeps marching forward. To some degree, it's not making a whole lot of sense. If you think about it in any other time frame, with the unrest that we have and have had over the last 6 days, you would have seen the market go down. But over the last 6 days, the market has continued to move forward. It doesn't make a lot of sense. It's not supported fundamentally. So we certainly are anticipating it coming down. We did blow through that last resistance we had, which was sitting right at this level here. The new resistance level is 31.30. So it's coming up to it right now. There's a little bit of bounce back today in the market. Could it blow through? It could. We do fully anticipate eventually we're going to be retracing in the market, and we'll kind of talk about that later. There is a side note from a charting standpoint, and that is this gap. A lot of times when the market gaps down, it has to fill that gap again. And it would not surprise me for it to go up, the market to go up, fill that gap, and then come back down again. Interestingly enough, that may very well coincide with earnings season, which we anticipate being very, very poor moving forward for the next quarter. So, you know, we're waiting and seeing. Again, charting is just one aspect of the investment process. There's many fundamental things that we look at. This is just one piece to the puzzle, but we are keeping an eye on it. Stocks, when you think about the historical bull markets and then subsequent recessions, they all had a peak and then they dropped. And in this case, from 1966 all the way to 2020, you had some pretty severe recessions. And when they hit the first bottom, there was generally a rally. Matter of fact, 100% of the time there was a rally. But historically, once that rally comes up, because fundamentally it wasn't supported, it begins to retrace again. And that's what we're anticipating here. So how much is it going to retrace? We're not exactly sure, but we are keeping an eye on it. You might note down here that the currently the rally for this bounce back is up 36%. You might look at how much the market went down, which was 34%, and say, well, shouldn't we be back to even at this point? Well, the math really doesn't work that way. Keep in mind that when the market goes down 34%, think of it like this. If your account went down 34% and you started with $100,000 and now it's 66%, you have less money to grow that back to where it was, which means you need a greater rate of return to get back to even. At this rate, the rally really needs to go up 51% just to break even. So as you'll see in a lot of our portfolios, we'll talk a little bit about what the institutional money managers are doing to actually get the returns out of the market while there is a rally going on right now. So moving forward, that brings us to the opportunities. And again, us being a tactical firm, we are literally tactical in everything that we do. It's just not investment strategies that we're tactical in. We're tactical in wealth enhancement, wealth transfers, wealth protections, charitable giving. And right now, the investment strategy, the investment consultant is enhanced by these opportunities and these strategies that we are putting in place for our clients. So let's take a look briefly at the strategies. If you want to go into this more deeply, you can go into last week's webinar, and I kind of talk a little bit about the different strategies and go into a little bit more detail of how they work. But let's look at the playbook that we have. Strategy one, well, strategy one is active management and reallocating sectors. In other words, when the market was coming down, in every recession, that which got you to the top from a equity position is not necessarily what is going to be the next winner when the market bounces back. So our institutional money managers understand that. So in the active or tactical portfolios, our managers have actually gotten rid of the dogs, the ones that will not recover quickly, and replaced them with positions that will do well and have been doing well. For example, one of our portfolios, Dana portfolio, removed airline stocks out of the portfolio as the market was going down. They replaced it with some tech stocks, which have just phenomenally went up over this time to help boost the returns within the portfolio. That's what active management can do in environments like that. Now, above and beyond that, there's 4 other strategies that we're putting into place. One is the Roth conversion. And again, simply with the Roth conversion, it's taking an IRA while the market is down, converting it over to a Roth account, paying the taxes while the accounts are down low, and then allowing that account to grow up tax-free. That is a very critical step in this strategy we have. Strategy number 3, we have the draw and let heal strategy. The draw and let heal strategy, again, simply is taking clients who are currently or were currently pre-crisis taking income out of the stock market. We actually have stopped that process because we want to stop the amount of money that's being pulled out while the markets are down. We have effectively used 2 other tools to replace that income. And one of those is a overfunded life insurance policy where we take the cash value out of it. The other, if you do not have an overfunded life policy, is using a home equity line of credit. There is another option out there, and that is if we have money on the sideline in bank accounts, we could utilize that. But it's all designed to allow your portfolios to stay whole so it can grow back as fast as possible, utilizing every dollar in there. Once the market returns back to their previous levels, we'll reverse that process. And that brings us to strategy 4, and that's reallocating risk up. So when you're down towards the bottom of the market, the risk of going lower is less and less. The opportunities, however, are higher and higher. So this is where we've set up the portfolios when we get to that point to actually risk up as the market goes up. And then when the market gets back to its original position, we will reallocate back to your normal risk tolerance level at that point. And then strategy number 5, if we have money on the sidelines, when is a good time to get the money into the market? Well, when the market's low. It's the old adage, buy low, sell high. So if you have money on the sidelines, and some clients have already actually added money to their accounts, waiting for the time when the market comes down, where we will then put that money to work for them and allow the money to go back up. So those are our 5 strategies that we're utilizing in this crisis. So that being said, that kind of brings us to the questions and answers. So I'm going to go ahead and bring Rocky back on at this point. So come on board, Rock.
I'm back.
So do we have any questions this week?
One of the questions I have is basically when you're looking at what's coming up in the 3rd and 4th quarter. So you're basically saying that you're expecting poor earnings and that the market is going to retrace a little bit.
Yes.
And is that like, are other economists seeing that? Are we hearing that from other people? So I think it'd be good to kind of refresh people on where we're getting a lot of our information from.
Okay, that's a very good question, because at this point we are not hearing from the institutional money managers or the economists that we're accessing that they think that this is going to be a V recovery. I know sometimes you see it on the news, but you got to take the news with a grain of salt. They are in the limelight, and sometimes they embellish a little bit. But what we're seeing behind the scenes from our institutional money managers is they certainly feel like there is going to be a pullback, because fundamentally the market is going up, but there's nothing supporting it but the news out there. Now, I will make this comment. There is a lot of money being pumped into the economy by the federal government and liquidity through the Federal Reserve. So that is helping to boost the market right now. But from a stock standpoint, fundamentally, it is not there. You will see in the next earnings reports that many of the companies are going to show very, very, very poor earnings for Q2, and many won't have guidance. And again, the market doesn't like uncertainty. The news drives it short term, fundamentals drive it long term. So everybody is anticipating a pullback. We're just not sure how much, Rock.
Okay. Yeah, that's good to know. It's always hard to figure out what type of recovery we think we are in, and has that actually changed over time. And our position is that we do not expect a V recovery. And there are some out there saying that, but the numbers and the revenues and the earnings projections just don't support it. So, good.
Yeah, and I would further add that when you're looking at the overall all markets, could it be that we end up in a V recovery? You know what? Stranger things have happened, right? Well, here's the good news. What happens if that is the case? Well, we went through a lot of work to make sure that we were ready for the market to roll over. And again, we still anticipate it happening. But what if it doesn't? Well, there's an old adage out there. It's better to be ready for an opportunity and not have it come than to have an opportunity to come and not be ready. In our view, we want to be ready. So if the market doesn't go down and it just continues to go up, the great thing is our portfolio managers are absolutely restructuring the portfolios to take advantage of that. If it retraces, well, then we can take advantage of all the strategies we've put into place, but yet have not pulled the trigger on it. So those are that's good news moving forward, Rock.
Okay. One of the questions we did get was on what does it look like for inflation or deflation moving forward?
Well, that's an interesting one. At the end of the day, we're spending a lot of money right now, and it looks like we're going to spend a lot more, which means more debt. We've said this in the past. We'll continue to say it. This country cannot support this type debt without some pullback on it. And the way you pull back is a combination of a robust economy and taxes. So we fully expect the taxes to go up. However, we don't think it's going to happen in the next year, 2 years, because that would be actually detrimental to the economy at this point. From an inflation standpoint, the inflation aspect, most economists don't believe, because of the way our economy is today and the way the Fed has reacted, that inflation is going to come in anytime soon. So we're looking at least 4 or 5 years before we would see any sign of inflation coming in. That's good news for stocks, not so good news for bonds, treasuries, and things. But, again, being a tactical firm, we're going to be ready for it. Okay, well, very good. Again, if you have any questions afterwards, you can certainly email Rocky or I. If you'd like to call us, we're certainly available. So we really welcome the calls. We want to keep you in touch. And again, overall, I think we're moving in the right direction, and we'll see what happens with the market, but we'll be keeping an eye on it. So that being said, I'm going to sign off and say goodbye. And Rocky, you can do the same thing, and we will see you next week.
Okay, thanks, Dan. And thank you, everybody, for joining today. We appreciate you being on board. And again, if you have any questions, just send us an email or call the office and we'll help you out. So everybody have a great day. Good to see you. Until next time, we say good night.